Good afternoon. My name is Nikita Desai. I'm the Director for Policy and Corporate Programs here at the Korea Society. Welcome to today's discussion. Before we get started, on the one-year anniversary of the Seoul disaster, ferry disaster, I'd like to offer a moment of silence. Thank you. We are delighted to welcome business leaders and members of the media in the audience today for the corporate program on Korea's economic outlook. With us today are two expert speakers, Charles Kimball of Korea Center for International Finance and Phil Suttle of Tudor Investment Corporation. It's my pleasure to introduce both of them. Charles Kimball is Managing Director of the Korea Center for International Finance. He was previously Chief Investment Research Consultant for Bosera Asset Management in Shenzhen, China. Prior to that, Mr. Kimball worked as an independent financial advisor focused on extended financial markets research and asset allocation at CTK Financial Services. For 10 years prior, he was an investment manager for JP Morgan Asset Management. He was also the head of investment research for Morgan Trust Bank in Tokyo. Mr. Kimball currently serves on the planning committee and head of evening programs for the Foreign Policy Association's Great Decisions chapter in Katona, New York. He holds a Bachelor of Honors in Economics from Harvard and an MBA from Stanford. Also joining us is Philip Suttle. He came here from DC today. He's the Vice President, Director of Global Economics at Tudor Investment Corporation. He joined Tudor in June 2013. He currently works as the Global Research Department and is responsible for the analysis of global economic trends and policy-related issues, as well as the development of Tudor's new weekly publication, Tudor Market Notes. Prior to joining Tudor, he was the chief economist at the Institute of International Finance, the IIF, in DC. He was also the global head of emerging market research at Barclays Capital, and prior to that, the global head of foreign exchange research at JP Morgan Chase. He's held various research positions at the World Bank, the Federal Reserve Bank of New York, the Bank of England, and the IIF. He spent most of his early career as an economist at London and New York offices of JP Morgan Chase, where he developed the bank's flagship economic product, Global Data Watch. Mr. Suttle received his BA also with honors in history and economics, and his MPhil in economics from Oxford University. Please join us in welcoming both of these expert speakers today. So, Charlie, would you please start us off on your economic outlook for Korea and your assessment of where Korea is at right now?
Yeah. Thank you, Nikki. Thank you for inviting us. I should mention, Phil and I worked together when we were both at Morgan, and so it's a pleasure being on the same stage with you. In the beginning, I think I should tell people what actually is KCIF, the Korea Center for International Finance. It was formed in 2000, shortly after the Asian crisis or the IMF crisis, depending on what one wants to call it, with the idea that that shall never happen again. Most of the people work in Seoul, and they've set up an early warning system to help judge what risks are and when they're increasing disproportionately. In the New York office, which I head up, small office, we mostly do qualitative research, not primary research, looking at consensus opinions, how they're changing, and thinking about how they may be incorrect and what are the biggest risks and or opportunities that may be presented to Korea. And so that's basically what I'm doing, writing reports, highlighting risks and opportunities. As a background on the Korean economic environment, I wanted to update people or not call attention to the history here, which Korea's growth has been extraordinary, as everybody should know. There was the period before the Asian crisis where the growth was over 8% per year, and then it came down by about half since the Asian crisis. Part of that was slower population growth, but a lot of it was lower productivity growth. These are IIF data. The forecasts going forward, I thought were a little bit optimistic. In the latest World Economic Outlook, the IIF is revised down from 3.9 to 3.6 their growth for the next 5 years, this year and the next 4. They've kept the population still growing at 4/10. I thought that looked a little bit high. I checked the CIA fact book, and they have it at 1/10. What that means to me is it's possible that Korea will only grow about 3 to 3.5% over this period, assuming there's no significant disruption in the global economy. The global economy is exceptionally important to Korea. At the beginning of this period in 1980, exports as a percent of GDP were about 25%, and now exports as a percent of GDP are about 40%. During that period, imports grew from low 30s to high 30s, so they swung from a significant current account deficit to a significant current account surplus. So a lot of the growth was related to establishing and growing out exports. When Nikki first called me, I had just returned from my latest trip to Seoul to meet with many of KCIF's clients. And at that time, I was using the JP Morgan forecast for Korea in terms of here's what I think the consensus is looking for. And as opposed to the prior 4 years when I had gone to Korea to make trips, when I was typically saying the forecasts are too high, the consensus is too high, both on Korea and on global growth. And what that meant for Korea in the last 4 years was your growth will be slower and your inflation will be a lot lower, so your real interest rates are much too high, so you should be cutting interest rates and that will help growth on the margin. This time when I went there, my view was it's actually possible that the growth will at least be in line with the consensus. It may even be higher because oil prices had come down so much. And for me, the background was that I chanced upon in connection with the geopolitical work that Nikki referred to up in Westchester, an article where a hedge fund guy, an energy-related hedge fund guy, had been talking about how we were at the cusp of a major change in the investment cycle. I read this in April, so exactly a year ago, but actually he'd written it at least 6 months before. So a year and a half ago, he was anticipating that oil prices would decline significantly because of excess supply. So that's what I was tuned into as oil prices dropped $5 a month in July, August, and September, and then $10 a month, more or less, the next few months, was that it was primarily supply driven, that finally it reached a tipping point where supplies exceeded demand and would continue to grow, and inventories would build dramatically and prices would come down dramatically. They came down faster than I expected, but by the time I went to Korea in December, the oil story was front and center as a big deal. And so for me, what that meant was that whereas historically Korea and Europe had been places where the consensus had gotten it wrong, the biggest errors in the consensus were in Europe and Korea, and it was causing pessimism in those two areas. I thought that this was a time where the pessimism was causing the forecasts for the current year, 2015, not to reflect enough on how good the oil price decline should be for Korea. In particular, what I was thinking was it's not only good in terms of the trade numbers, because obviously Korea is a major importer of oil, but it was good for consumers, Korean consumers, and at least equally important as a major exporter. All of Korea's major markets, that is China, the United States, and Europe, are net importers. And so lower oil prices should have been expected to help all of them. So that was my expectation back in December. And I noted, when I was meeting with people at MOSF or at the BOK, that with stronger real growth than was being experienced in the recent years, that would probably mean that fiscal stimulus could be restrained until it was really needed. As I'll later talk about, I'm in the camp that even though I worked in China and was very positive about China when I worked there from 06 to 09, I've gotten increasingly concerned about China, which would be a significant risk for Korea. But if you look at an update of the JP Morgan numbers, what you see is they basically push the forecast out another year. In other words, good growth will come to Korea next year, not this year. And that's typically what they've been doing the last 5 years, not just for Korea, but for the world as a whole. And so to me, this is like a major disappointment. What happened to the growth in Korea, to the global growth? And what we see in this slide is global growth has been somewhat disappointing. For this year, it's been revised down from 3.4 to 3.2, but that's not a big deal. The IMF has recently released data which is similar. They've cut their estimates slightly, and there's been little apparent benefit from oil so far, and so one question is that yet to come, or what happened? Now, for the United States, it's offset by the strengthening dollar, but for Europe and China, Europe in particular, and Japan, growth should be doubly influenced by weaker currencies and by weaker oil. And we're not seeing that as much as I would have anticipated in a global aggregate sense. I know Phil will talk more about Japan later. I also wanted to talk a little bit more about China before moving on to Japan. And that was to say that for me, the major risk that South Korea faces is not that growth in China may continue to slow by 0.5% or 1% per year for the next few years, but it may slow sharply, unexpectedly, in which case the capacity that Korea has built up to export to China could be excessive. And so that's a major risk that's out there. And for me, this comes not from working there, where I saw the capability of people in terms of their educational experience, meaning that they would be massively more productive than their parents' generation was, but looking at recent numbers showing that debt to GDP at multiple levels in China is rising rapidly at the same time as growth is shrinking, and so that the marginal productivity of debt in China is dropping dramatically. So that to me is a significant addition just to the observation of, wow, they've built a lot of capacity in housing, and maybe it's excessive now. And then the final thing was the latest numbers that they reported for the first quarter. While the year-over-year number was 7, the quarter-to-quarter number was more in the 5s, and that's worrisome in the direction. Now, I do not doubt that they will stimulate enough to get this number up toward the 7. It may not reach 7, but I'm just worried that at some point they will not be able to do that. I guess I'll leave with that note of caution and pass it on to you.
Okay. Charlie, thank you very much. I think Charlie's got some additional discussion topics, which I'm sure we'll come back to
Later.
But if I may, I'm just going to spend a few minutes giving you some broad outlines of some ideas that I have on Korea and the economic outlook. I mean, one way of thinking about Korea is it's your consummate, with due respect, your consummate small open economy. By small, I don't mean it's an insignificant economy. It's a very important, powerful economy. But relative to those around it, it's your consummate small open economy, essentially being buffeted by a lot of shocks at the current time. So the economic outlook is bound to be affected by all those shocks. And Charlie spent a little bit of time talking about one shock that actually in principle should be quite positive, which is, and I agree completely, which is the oil price shock. But I think there are two other, maybe I shouldn't use the word shock, two other developments, two other trends going on that are clearly affecting Korea from the outside. One is the trend in China, which again Charlie talked about, and I want to come back to think about that and what it means for Korea. And it's clearly, at least in my view, it's a trend towards significant and sustained slowing in Chinese economic in the growth of Chinese economic activity. And the other, which I think is even more important, is Abenomics and Japan's decision to go down the route of, putting it bluntly, competitive devaluation, and what that means for a small open economy like Korea, which in particular, at least in my view, competes in many head-to-head sectors with Japan, and in some senses has been a major beneficiary, one might say, of Japan's previous policy, which was to keep the yen somewhat overvalued and put up with deflation. So to the extent that at the end of 2012, early 13, Japan decided no more of that. I think that policy shift in Japan had profound implications for Korea, which I think we've been seeing in the near-term economic outlook ever since. Because if some of Charlie's slides highlighted that. Because if you look at sort of how Korea's developments have played out since the early part of 2013, we've had a pretty consistent slowing in economic growth in Korea and general disappointment about the outturn in performance, both at the macro level and at the corporate level, as well as sustained disinflation in Korea, which obviously most recently has been the result of falling oil price. But I think where that leaves me is the basic proposition that I personally think Korea is headed into what the Japanese would have called a decade ago ZIRP, zero interest rate policy. In some ways, it's just a case of Japan following the rest of the world, and much of the rest of the world has not just gone to ZIRP, it's gone to NIRP, or negative interest rate policy, or if you somehow, I'm not sure how you pronounce this, but put QE on the front of it, have quantitative easing as well as negative interest rates. Maybe that's where Korea is headed. Because an additional point I would make here is that when your nominal growth slows, and Korea, I think, is a consummate case of a country that's seen it and done it. When your nominal growth slows very dramatically against expectations, and you're a very heavily indebted economy, not necessarily externally, but by sector, there's a lot of debt out there. That debt is often conditioned on an assumption that income growth will be quite high. Turns out income growth is very low and disappointing, and all of a sudden you have debt sustainability concerns creeping in. Obviously, that's something that became most evident first in Korea in 1998, and then I think it was 2002, 2003, we had another bout of it in the household sector, and then in 2008 we had another bout, and I would say we're not through the last of those debt concerns. Actually, I'll throw in a little anecdote here, which shows a mixture of my experience and naivety on some of these issues, and the relevance, I would also say, of Japan. I worked in JP Morgan in the late 1980s, 1987 to be precise, and worked with a chap called Steve Thieck, who was then our lovely guy, who was then our chief risk officer. And one day in, I think it was something like August 1997, about a month and a half after the Thai devaluation, we had a visit from a very senior official from the Korean government who was on a secret mission around the world to talk to the major banks, to ask them if they would maintain their credit lines to the Korean banking system, because they were being pulled, very aggressively at the time. And it wasn't wholly evident in the markets, I don't think, at that point. In other words, the looming Korean crisis wasn't fully foreseen. And Steve and myself sat with this gentleman, and we sort of heard him out. And then afterwards, Steve said to me, "What do you think? What should we do?" And I said, "Well, looking at all these fundamentals for Korea, they look fantastic. This is still a very strong economy with great potential, and very strong corporates. These great chaebols, they're really very strong, potentially very strong export performers. And most important of all, the government has no debt. So there's no way that Korea can ever go bankrupt, because look, there's no debt for the government, or virtually no debt, certainly very little external debt." Little was I thinking about the role of Japan, because while all this was happening, the banks that were pulling their lines to Korea, as JP Morgan and other American banks maintained theirs, the banks that were pulling their lines were the Japanese banks, who had no choice in some sense, because they were being killed by what was going on in Thailand, Indonesia, and even in their own economy. And within 3 months, we were effectively in default territory for Korea. And JP Morgan faced a major loss based on, I guess, my judgment call. So I learned very painful. The good news, of course, is everything turned around very quickly. It wasn't great news for the Korean economy, because you went through a wrenching recession. But I think, to me, it was my first great example that for a small open economy in both real and financial terms, Japan matters a lot to Korea. But let me go on. You've got I think in front of you some slides, and these pictures, I apologize, may not be totally beautifully visible to you. But what I want to highlight here is I think Japan in some ways I think matters for Korea for two reasons. One is the sort of anecdote I just gave you, and in a moment we'll look at the exchange rate, and I think that's a kind of reminder that you know, the won-yen relationship has moved very, from a competitiveness standpoint, very adversely for Korea over the last year and a half. But I think the other way Japan matters is it's a little bit of a role model. You know, Japan, in some sense, for many of the countries in Asia, tells us kind of where we're headed. And you know, at Tudor, we believe in looking at these analogs quite carefully because, you know, the rhyme of history sort of repeats itself. And I would argue with something like a 15 to 20 year lag, Japan looks like it's following the path of China, of Japan. And in fact, China's relevant because with something of a 10-year lag to Korea, China looks to be following a similar path. Now, there's all sorts of reasons for this, most importantly, perhaps demographic. There's also the whole concept of sort of technology catch-up and the tendency to sort of, in this rapid growth period, to overreach yourself. And that, you know, you then end up with debt problems and that leaves a legacy of slow growth. So there's all sorts of reasons why this happens. But to me, it's very important to get one's mind around the basic point that it's happening. And the tendency, I think, will be for the next few years, and Charlie's presentation, I think, highlighted this very nicely, to sort of always expect a rebound to what it used to be like in Korea. You know, 5% growth, 4% growth. And in fact, my suspicion is this is an economy headed more towards the 1 to 2% growth range. And as I say, I think that matters because if you've got a debt structure that's conditioned on nominal GDP growth of somewhere 7, 8% or north of that, if you only get nominal GDP growth of 2 or 3%, that can be a problem. In fact, the other piece of the nominal GDP growth puzzle, the inflation side, you could argue looks even more worrisome for Korea because here, once again, the analog with Japan is following quite nicely. And you could argue where Korea is today is sort of where Japan was in the early 1990s, late 1980s, early 1990s, just about to tip into that sustained deflationary period. Again, these analogs don't always work. There's no necessary sort of relationship that has to follow. But history does appear to be rhyming at the current time. And, you know, as I mentioned just a few moments ago, I think one reason for that is because of the change in strategy on the part of Japan at the end of 2012, 2013, which fundamentally, I think, tilted that won-yen relationship back in, you know, I could put it crudely, back in Japan's favor, a cheaper yen relative to the won, which clearly helps. I think we're in the Samsung room, is that correct? You know, clearly helps Sony over Samsung. You know, the last 10 years before that was all about Samsung taking Sony to the cleaners, literally, metaphorically, whatever. Now this could be somewhat a decade where we look, you know, the same's true of the car companies, etc., slightly in the other direction or move in the other direction. Let me just end with a final analogy, if you like, here, which may or may not appeal to some in the room with more of a European heritage. I actually think one way of thinking about Korea is it's got many of the same characteristics as Sweden in Europe. Again, small open economy with a very vibrant manufacturing sector, inevitably dependent upon what's happening around it, but looking at, in Sweden's case, to the south and the east, in Korea's case, I guess, to the west, and to, well, all around, looking at neighbors who are slowing in deflation and flooding their markets with liquidity. I mean, those conditions are certainly all true of Japan today, and my suspicion will be, over the next few years, China will have more and more of that tendency, slower growth, more liquidity. And I think that leaves, frankly, the Bank of Korea very little choice but to go down the route of the title of my talk, which is to go to a policy of zero interest rates. They can fight it all they want. They may say, well, we've got a financial stability problem, too much debt. You know, if we cut rates even more, they would have even more of a debt problem. Well, actually, it works the other way around, and Sweden is a great example of that. They've got excessive debt, but they've had to cut interest rates because what they've found is if they don't cut interest rates, they end up with too much deflation, and deflation is your problem when you've got big debts, not so much low interest rates. So I'll leave my comments at that point, and Charlie, you may want to pick up on some of these ideas.
I had seen your slides in advance, so I knew the direction you were going, but it's still interesting to hear you, and particularly about the Bank of Korea should go to a zero interest rate policy, because for me, the clear message out of Sweden is don't under any circumstance raise your interest rates in this environment. That would be terrible, because Sweden did that briefly and had to take them back. The other thing that I liked about that was that when I was in Korea in December, people were concerned about disinflation. And my reaction to that was, well, if you get disinflation, you know, in 2015, it's going to be because oil prices fell, and that's not bad disinflation. But what you're talking about is much more intermediate long term, and that's much more dangerous.
Yep.
And so I would agree with the conclusion that you would have, which would be to say, you know, the Bank of Korea should look to be aggressive about getting interest rates down before they get into long-term disinflation.
Yeah, I mean, I think obviously where I work now, which is a hedge fund, it's all about what will happen as distinct from what should happen.
Oh.
Now, having said that, if I was sitting in this seat of the central bank governor of Korea, I probably would say, look, it's time to be bold. But I can see why you'd want to be cautious because, once again, this is an economy that's had 3 bouts of financial instability brought about, one could argue ex post, by reckless domestic, somewhat easy monetary policy.
Yeah, when I first,
easy.
excuse me,
Sorry, go ahead.
when I first went to Korea in this position, which was about 5 years ago, they were really concerned about not wanting to repeat the error of before, which was encouraging too much consumer debt.
Right.
And to me, that's the old war. This is a different battle they need to fight. But not to belabor this too much more, the other thing you mentioned was competition with Japan on a currency level. And I know you and I have talked a few times about this because in late 2012, early 2013, with Kuroda coming in, I interviewed a lot of people in the financial community about what did they expect would happen to the yen over an intermediate period of time. And some people said, well, it's currently at 84. That seems fine. That's probably okay. The consensus, I would say, among the foreign exchange traders I talked to was it might go to 105, 110. There was one person who I talked to who used to work with Citibank as a trader, and she thought, well, looking at charts, it could go to 124. Phil was the outlier. He said it could go to 150. He said these things always overshoot. Now, you may have changed the direction in the opinion of 150, but clearly the direction was right from 84 to 120, more or less. What has surprised me is that Japanese exports haven't really picked up as much until recent months as I would have expected, given that the currency declined a little over 2 years ago. It began declining sharply. And my presumption has been that once exports pick up significantly, then the next shoe to drop in terms of competition versus Korea is when will the Japanese companies start expanding their capacity? When will they make significant new investments because they really believe that it may not stay at 120 or 130, but it's going to stay over 100, 110, and this is a good number for us.
Yeah. No, well, thank you for remembering. I probably said different numbers to other people, so I'm glad you came along. No, but sir, exactly. No, but I think to me the important point here is that what Japan is doing is obviously very focused on reinvigorating their economy with clear spillover effects to other economies, and I think most obviously to Korea directly. I don't think it's going to, if you look at this chart, you can see the last time, my eyesight's so bad, but I think that last time we dipped anywhere near as low as where we are now was 2007. And that was the last time Japan sort of got things going. Everything was, kind of working. Then all of a sudden it fell apart. Now you'd say it fell apart because the financial crisis globally. And I think that was a big part of this. But I also think, the political consensus within Japan fell apart. And, we were no longer in the Kazumi era. We were back into that era of the BOJ saying, well, maybe we have to put up with deflation. It's all structural and all. I don't, political weakness was a key feature in Japan, etc. I don't see that changing. I think Abe is very strong. And the strategy is not going to change for the next 2 or 3 years. Kuroda, will keep pushing or he'll get fired. One of the two, I think.
Speaking of trade, could you comment a little bit on the Trans-Pacific Partnership? Both Japan and Korea have expressed interest in joining, and it's definitely been on top of newspapers lately with President Obama working on it. So
you want to go first? Well, I think this is one of these odd areas where the benefit is, you could argue, put it this way, geopolitically, I think there's an odd relationship developing here between Japan and the US. They're almost like the odd couple, left out a little bit. And they see things happening with China, getting friendly with all other bits of the world that maybe they're not so keen on being related to and all that. So I think the biggest push for TPP actually is going to be this perception that, between us, we need to pull something out of the fire to get. Now, the problem here is, of course, in the US, we have a big issue with the president, promising something but not being able to deliver it. We've seen that with the Iranian negotiations, and that I suspect would also happen with TPP. Japan, the obvious point is that, you're trying to change things that have been impossible to change for many, many years, most obviously agriculture. But I think the fact that Abe is so powerful, I think some real change is occurring from what we can see. So I think there's a good chance as we go through the summer months that we'll get some kind of deal. What will it do for Korea? You could argue Korea's already got its free trade agreement with the US. And so, does it really benefit from that? My sense is it's probably another net negative, with due respect, because I think it sort of adds to the perception of this third country getting potentially squeezed out a little bit.
Now, my take on TPP is a little bit different from the traditional economist. We all love free trade, and that's what
trade is good, right? Trade
that's
is
what
always
the
good.
idea is behind this. And I would take a slightly different view of what I think may go on in Washington in terms of giving Obama fast track and getting something through. There'll be some complaints from the Democrats about whether or not he'll be dealing with the environment and labor very much, but I think he'll be able to get fast track and get it through if there isn't a significant buildup of citizen concern against it. Because what I think is going on behind TPP is our system in the United States has moved heavily from when I first went to Washington to meet with senators, congressmen, CBO people, members of the administration. It cost almost nothing to have meetings with people of significance in terms of the commissions that JP Morgan paid. 10 years later, the cost had gone up tenfold in terms of what it costs. And I don't know, but I presume it's gone up by an order of magnitude in each decade since. In other words, it costs very real money to access these people. Obviously, we know about campaign finance and about lobbyists and the power thereof. What I'm worried about with TPP is the details that we don't know about. Last week, I was at a meeting up at Columbia, and Stiglitz mentioned a couple of things, one of which floored me, which is the tobacco industry is getting something in there that would protect the tobacco industry from suits by foreigners that would say that they shouldn't be responsible for people's deteriorating health. Now, that to me is outrageous. Why should the tobacco industry get that? And he continued when I spoke to him on the side that will protect them. It will set up a baseline to here's where we are now in this country with environmental or, civil suit legislation protecting the current baseline. Another part of TPP that worries me is copyrights and patents that will extend the pharmaceutical industry's trivial changes, allowing them to extend the number of years. So it's not obvious to me that this round of TPP is going to be, all good and wonderful, free trade is better, unless we look at the details more closely.
Can I give me one additional observation, which again I think matters a lot for Korea, which is that we seem to be in a world that I'm not sure I understand why, where trade output elasticities are falling. I mean, you could argue it was the period from sort of the mid-90s through to the mid-noughties, or whatever we call that decade, was the period of real globalization, when for if output went up 3 points, trade went up 12 points or something, whatever the relationship was. Now, although output growth is much slower than it was, and we were hoping it to be, what's even slower is trade growth, and I think that's something that we're not sure exactly what's causing it, whether it's just a sort of, we've had our globalization out and now we're settling down to the new normal, or whether there's some of these sort of hindrances which are getting in the way, in which case, I'm not sure what TPP would actually do to that. Maybe it would help, or maybe it's just, hard to get around some of these things these days.
Yeah, that may get into another topic that I know Nikki and I had put up on the slide, wanted to raise, which was the AIIB, the Asia Infrastructure Investment Bank, which it to some extent depends upon what do we think the AIIB might be orienting its money toward. If I were China and steering it, I would be very glad for a lot of the money to go into, what should we say, underdeveloped or undeveloped regions west of them, and provide demand for Chinese steel, among other things. But in that process, they also could open up another part of the world to significant development, productivity expansion, and trade, another place to put trade. But right now it's tiny anyway. I don't think that on the margin helps what you're talking about in terms of declining ratios of trade versus output. I think that's on the margin.
Mm-hmm.
Yes, Phil, given your experience with the World Bank, how do you see this bank developing? What do you see the role for the AIIB?
Well, it's interesting. I mean, having sort of seen, the World Bank's a great example of a bank that was created to do this, but then couldn't find enough of it to do, in some sense. So the World Bank got forced to turn to lots of other sort of more basic kind of shadow IMF type activities. And the reality is, we're not short of institutions to do this sort of activity. I think what it really reflects is, the geopolitical focus here of China getting more of a role in running things. This is clearly a Chinese dominated institution, Chinese sort of generated institution. And fair enough. You could say, well, the US and Britain used to do it in the 20th century. It's Asia's turn to do it in the 21st century, or China's turn to do it in the 21st century. So to me, it's got much less of an economic need than a sort of geopolitical need. And the fact is, it's happening. I think the last 3 months have been fascinating on this, and the guys who sort of made the decision, I think, that tipped it to make it, this is going to happen versus this is still a dream, were the Europeans, who said, London started it by saying we cannot afford, we want to be the center of the RMB market, the offshore RMB market. Sure. One way to do that is to please the Chinese by saying, great idea, we'll go with your project, even though we're going to upset Washington. And then as soon as the Brits went, the rest of the Europeans followed. And I gave you my example of Korea's parallel in Europe, which is Sweden. And 2 weeks ago saw the Swedish Prime Minister in Washington when he passed through, coming back from China, I might add. And he said, we can't afford not to be part of this organization because we've got all these capital goods producers and we want to be a big part of all this Chinese capital spending boom that's going to go on, that's going on. And so we want to be,
does Korea.
Absolutely,
right.
Absolutely.
Well, with that, I'd like to just make a quick note. June 18th, we're going to have David Dollar here to discuss more in depth the issue of Korea and the Asian Infrastructure Investment Bank. So I hope you come back for that. Thank you, for coming out this afternoon, and thank you to both of our speakers for a fascinating discussion.
Thank you.
We welcome you to take a look at our summer calendar, which will be out in a few weeks. And please, if you're not a member, sign up for membership. And you can watch more of this and download podcasts on koreasociety.org. Thank you.